everyone, and welcome to the technical analysis session. This is the first session, and we'll cover the basics, and thereafter, in the further sessions, we'll go to the thoda sa more concepts about the technical analysis. So, as I believe all can share my see the screen, so we'll move ahead. So, thing is that money grow on trees, and the right time to plant your orchard was maybe about 20 years back, and the second right time is, if you're not planted, is now, and it will reap the benefits in time to come. So coming about trading and investment, so there are three aspects of investment and trading which can help you in becoming a consistent, successful trader. Now I'll keep on saying that consistent, successful trader because that's the main aim, to be consistent, successful trader. Uh, Morning, sir. We are just started, so I hope you're not missed much. We started about a minute back. We'll continue with the presentation, sir. I'm not able to hear you, sir.
Okay, can you hear me now?
Yes, sir, I can hear you now, sir.
My laptop is not working. Why it is like this? I've opened the laptop also.
I am not sure, sir. Maybe some problem in your laptop.
Let me speak. Let me do it. All is being recorded here. Now I open it.
Yeah, sir. So please mute your mic, sir, because it's echoing. And we'll continue, sir. We have not missed much. We have just covered the first slide. Sir, can you please mute your mic, sir? Cheda, sir.
Yes, I'm not able to see the topic.
Okay. So as I covered that our main aim is to be consistent, successful trader. And there are three aspects of investment and trading, which are very important, which one should master to become a consistent, successful trader. Now, these aspects are, the first and foremost is fundamental. You should know about the fundamental aspects of stocks, and which Divyan Jain is already taking us sessions on. And plus, I think this is the ABCD of stock market. If you don't know fundamentals about it, fundamentals of stocks, then you will not be able to be a long-term investment or trader. Finally, everything is governed by fundamentals. But there are few aspects which fundamentals is not covered. So we have technical analysis for that, in which we are able to find out the short-term movements of the stock market. So we will see that fundamentals are for long-term movement and technicals are for short-term movement of a stock or any commodity. Thereafter, we come to about derivatives. Now, derivatives was started somewhere in 2000 or so, or maybe just 1 or 2 years before that. But derivatives is a great tool to optimize your returns. So it's very important to have good knowledge of derivative also, which will help you in enhancing your returns and if you have knowledge of fundamentals, technicals, then derivatives helps quite a lot in enhancing your returns, and it helps you in able to generate returns in all kind of phases also, which we'll cover in subsequent part of the session or maybe in the sessions to come. And apart from that, the last thing is psychological aspects are very important. One should understand the psychology, not only the psychology of market, but a psychology of himself or herself also. You have to understand yourself also very well, and you have to understand market psychology and what you should expect from market, and that will govern a lot of your success and failures in the market. So coming to the what is technical analysis, we'll cover a few things like what is, I'll briefly introduce you to a technical analysis. Thereafter, we'll cover various assumptions of technical analysis, how to do chart reading, what are the various patterns, how to use these patterns, what are the various indicators, which will come in subsequent sessions, and how to effectively use technical analysis to generate returns. So this will be all part of technical analysis session. Of course, I will not cover everything in today's session. I will cover only few things in today's session. In today's session, we'll cover what is technical analysis, what are the various assumptions of technical analysis, advantages of technical analysis. Then today we'll learn about various types of charts, various types of candlestick patterns, and then we'll move on to single candlestick patterns, how to put stop loss and how to trade these patterns. Similarly, we'll go for multiple candlestick patterns. And in the last, if time permits, we'll cover trends and type of trends in the market. So what is technical analysis? Technical analysis is generally a relationship between price volume and supply demand for overall market and for individual stock. So there are various definitions, but this is the most, I say, apt and very crisp definition, That technical analysis is basically a study of relationship between price, volume, and supply demand for the overall market and the individual stock. Now, I will like to explain it with an example. Now, let's suppose you go on a holiday and you are in a foreign location and you want to have some food. So you ask someone that how can I have a food, and he guides you towards a eatery street. वहाँ पे there are number of shops are there and there's a food available there. Lot of shops are there. Now you have to decide that which shop you want to go and have food in. Now there are various ways of doing it. One way of doing it that you go to each and every shop, you check their menu, what is the menu, what is the price list, and all those things. Then you go to the review rating, and you see okay what are the reviews of various hotels and various eateries, and thereafter you decide and you come to a conclusion. Okay, this is the best shop, and I'll have food there. So this is more of a fundamental analysis where you are going to fundamental of each and everything. You are going to the what kind of restaurant is that, what is the chef doing, how is the food and all those things, what is the cost and all those things, and thereafter you're deciding. The other way of doing is you just look at the place जहाँ पे सबसे ज़्यादा लोग are having food. So most likely that place is the best place around that street. So that's why most of the people are going to that shop and having food. Chances are very high that this will be the most reasonable shop and will have good quality to the customers. That's why most of the customers are there. So this is broadly what technical analysis is about. We believe that since most of the people are doing this thing, so that is the right thing to do in technical analysis. So I hope I have made this example very clear and people are able to understand it. Now we come to the what are the various assumptions of the technical analysis. So first and foremost analysis is that market discounts everything. So we don't question the market in technical analysis at what price the market is. We believe that whatever the price the market is discounting all the information, all the knowledge which each participant it has. That's why it is showing that price. Then comes this that what is more important than why. It means that you don't question why this thing is happening. What is happening is more important. Like if market is going up, then don't question it that okay why it is going up. There's a Israel-Iran war going up. US dollar is this thing that why market is going up. You don't question the why part of it. You focus on what is happening right now. That and how to take advantage of that thing. So that is what technical analysis is about. Which there's a one more assumption that what is more important than why. Then third is that price always moves in trend. So there are various trends in the market which we'll cover in this at the end of this session itself. That there are various trends in market, and generally price moves in those trends only. And with the help of the trends, we are able to ascertain what can be the future outcome in the market. And the last assumption is that history tend to repeat itself. It means that whatever has happened in the past, chances are there the same thing will happen in the future also. For example, so let's suppose in the past we have seen that whenever the Infosys stocks falls for last 5 days and 6th day, after falling 6th day, if there's a green candle, then thereafter market goes up by 4-5%, Infosys goes up by 4-5%. So we'll assume to believe that whenever this pattern happens next time also, whenever the Infosys falls for 5-6 days continuously, and there are certain other parameters are getting matched, which we'll cover in this presentation, then chances are there that it will behave in the same way as it has behaved the last time. So this is one more assumption of the technical analysis. So throughout our covering of technical analysis, we'll keep these assumptions in mind that these are the basic assumptions of technical analysis, and market will move and behave in with these assumptions. So coming to what is the difference between technical analysis and fundamental analysis? So what happens in technical analysis? We believe we read into charts and indicators, and there are various theories like Doe theories and all those things, Elliott wave theories, and we based on those theories we take our decisions. However, what happens in fundamental analysis is we do a company analysis, maybe an industry analysis, depends whether you are doing a top up or bottom down approach. And we come to maybe economic analysis also, and thereafter we come to the conclusion and we decide what we have to do. So these are broad difference between technical analysis and fundamental analysis. So fundamental analysis shows you are trying to find out the financial strength of the corporate, growth of sales, earning and profitability. And in technical analysis, you are mainly focusing on the price action and what is the chart telling you. In fundamental, we are trying to estimate intrinsic value of a share, and in technical analysis, which mainly are predicting a short-term price movement. So fundamental, you can say, is for long-term, and technical analysis helps you getting a short-term advantages. And So there are many factors which determine fundamental, and similarly, there are many factors which determine how to find out a technical setup. So, however, there are certain advantages which are there with technical analysis, which help us in overcoming certain shortcomings of fundamentals. So, first and foremost is that market is not always rational. So, for example, fundamentally, there's no value of Bitcoin. If you see, Bitcoin is not generating anything, but you can still trade Bitcoin with the help of technical analysis. Similarly, fundamentally, what can happen? A very good stock, which may be fundamentally very lucrative, may underperform for a very long period of time, and trader or investor may lose patience in that stock because he may be holding that stock for many years of time. However, with technical analysis, there's an advantage because it's a short term in nature. So you come to know about these breakouts and you can enter these kind of stocks at the right point of time. For example, like there was ITC at one point of time when it was not doing anything for many years, about 4 or 5 years. But then when it broke out, it went up about more than 200, 300% up. Similarly, is the case with SBI also. So sometime what happens, though the stock may be fundamentally very good, but it may not perform for a long period of time. But technical analysis help us in spotting these opportunities, and we can participate in the performance. Now, other shortcoming of fundamental analysis is fundamental analysis mostly is based on the future earning assumptions. So we generally, when we are reading about fundamental analysis, we try to find out what will be the future predictions. Okay, this company will grow at 20% sales because its market capitalization is likely to be increasing by 20% or so, and that's why the price should be trading at maybe about 20 PE right now. So it will trade at 25 PE or something like that. So we'll do that kind of thing. But what we don't realize is that many of these factors may not come true in future because these are all assumptions. So things can change, which can change the fundamental nature of the security itself. So that's why sometimes fundamental analysis may not work out so well, and in that time, technical analysis has an advantage. So other advantage is that basically when we are doing technical analysis, we are reading the supply and demand of the stock, and based on those supply and demand, we are taking decisions. The good advantage of technical analysis is that is applicable to all kind of assets. Like in fundamental, you have to understand each kind of stock in a very different way. Like FMCG stock will have a different fundamentals than auto stocks. So you have to understand that auto stocks, when you're reading, you have to do a lot of other studies. And when you are doing FMCG stocks, you have to do some very different kind of studies. Similarly, for commodities also, you have to do different kind of studies. However, technical analysis, once you have learned it, it can be applied to all kind of assets, which will let it be equity, commodity, currency, and best part is you can do it in all time frames also. So technical analysis is used by those people also who are long swing traders, like who have a horizon of maybe 3 months or so, or maybe a weekly traders, something like that, who have 2-3 weeks horizon or swing kind of trade, and even for intraday or 1 or 2 day kind of trades also. So it's applicable to all class of assets, almost applicable to all kind of time frame. That's the advantage of technical analysis. So now we move to the next part. I hope till now everyone is with me and things are clear. If it's fine, then just you can press a thumbs up so we can move ahead. Okay, sir. Fine, sir. Any questions, sir? Okay, fine. So now we go ahead and now we come to the next part of the session in which we come do chart speaks. So of course, do chart to speak, we should know how to read the chart. Any questions, sir? Vishal, sir?
No. I just giving the thumbs up. That's it.
Okay,
Thank you.
right, sir. Okay. So do chart speak? Yes, chart do speak. However, again, like technical analysis, there are certain basic assumptions of charts. So as we have seen earlier, that stock prices are determined solely by the interaction of demand and supply. And as we covered earlier also, that stock prices tend to move in trends. When there's a shift in demand and supply, there are reversal patterns, which we'll cover maybe in the next session, how to find out the reversal patterns. And through this reversal pattern and through these other patterns, we are able to detect the supply and demand of a stock. And since the chart pattern keeps on repeating themselves again and again, we are able to take some short-term decisions, some short-term technical decisions, in which edge is on our side. Like edge means that probability of happening of one event is more than the probability of happening another event. So if you see, there can be only 2 probability or 3 probability. If you buy a stock, either stock will go in your direction, or it will go against your direction, or it will remain in the same place. So only these 3 probabilities are there. So we are trying to look for those opportunities jahan pe we probability of one event happening are more than the probability of other event happening. Now coming to the type of charts, so there are different kind of charts. First chart is line chart, then we'll cover bar chart, and then candlestick chart. Now coming to line chart is very simple. It was the like oldest chart. So what people used to do is whatever commodity is there and whatever time frame is there. So whatever the opening price, either people used to choose opening price or the closing price. Uspe they used to put a dot, and then they used to join these dots, and that's why the line used to get formed. And so a chart appears to be something like this, jahan pe ek line is there, and this generally gives the broad trend of the market. So this is Nifty ka line chart, and if you can see, all the points have been joined, and it generally gives the broad trend of the market. What is the broad trend of the market? However, there are certain disadvantages of this chart. The disadvantages was that you don't know what has happened on that day. So it used to miss out a lot of data point. So that's why from line chart, people started using bar charts. So which used to give slightly more details. This bar chart they used to have like you are able to find out other data also, which is open, high, low, and close. So bar chart, because of bar chart, we are able to find out more. So this is like what a bar chart looks like, and I will cover it in detail how the bar chart is there. So what happened? Each bar is like it's of a time frame. It can be 1 minute also. It can be 1 day also. This is a bar chart, and it gives you an open price. So suppose this line is there, and the left dot is the open price. That it means that it opened at this point, and the right is close price. It means it's close at this point of time, and this is the highest price at which this is the highest price for that time period, and this is the lowest price. So let's suppose we decide a time period as of now 1 day to keep it simple. So we'll say that at that day market opened at this point of price, and then throughout the day it would have made a low of this point, and throughout the day it may have made a high of this point, and then closed at this point. So this is how 1 day represent or one time period represent in the bar chart. Similarly, if suppose it has a negative closing, it means it opened at this point and closed at this point. So it means a negative closing, and this was the highest and this was the lowest. Similarly, it means that this point means that it opened at the low point of the day and closed at the highest point of the day. So this is how bar chart and each candlestick looks like. Just opposite of what we have covered, opened at the highest point and closed at the lowest point of the day. So this will mean that it opened and closed at the same point, but for the day it moved to this point as a low point and must have recovered and thereafter closed at the same point. Then this means that it opened at the low point. Throughout the day there was a recovery, but at the end of day it closed at the same point where it started. So this is bar chart. And this is the doji, which means that it opened and closed at the same point, but throughout the day it went made a high of this point and made a low of this point. And this means that it did not move at all. It opened, closed, high price and low price are exactly at the same point of time. It happens on very low volume day when the time period is very short sometime. So this is how the bar chart are being formed. But then traders realize that in the bar chart also there are certain shortcomings. It gets confusing a lot of time because of a lot of small lines are there, and people tend to miss out which is the green day and which is the red day. So to overcome this thing, candlestick chart pattern came into being somewhere in around close to about 1800 or so. And these are known because they were started by the Japanese traders. So these are known as Japanese candlestick patterns. And most of the names are, that's why terminology is mostly Japanese for these candlestick patterns. So candle is almost the same as bar chart, only thing they have colored it. And now throughout our time, throughout our these sessions, we will use these candlestick patterns for understanding of things. So what happened in candlestick patterns is pretty simple. Only thing, if it's green, it means it is a green market must have opened here and closed at the highest point, and these are the shadows. Shadow depicts the lowest price at the highest price of the candle. And this is a bullish candlestick because this is green in color, and red color means bearish color, means it must have opened at the highest point and closed at this low point, and in the day it went up and went down quite a bit. So this is how a candlestick chart pattern candlestick looks like. and these are the various candlesticks. So this is like a small doji in which it's a small candle, means very small body. This is a red, it's a spinning top sort of thing, which will cover subsequently. Okay. So now since we have seen that what happens in the chart, now we cover to the individual candlestick patterns, which we'll cover it later also. So this is the candlestick pattern, which is very small body. Okay. And this is again a small body candlestick pattern. This is also known as spinning top. So spinning top, it means that there's no decision in the market, in the sense that market opened at this point of time, it went up, went down, and closed almost at the same point. So it means that traders are not able to decide which way market is going to do. So there's an indecisiveness in the market. Similarly, if you see this candle, this is known as bullish Marubozu. It's a very important candle, and it's a very important candle, and it is very bullish in sign. If you see, so what has happened this day, that market opened at the lowest point and thereafter closed at the highest point of the day. So it means that throughout the day there was a buying pressure. People kept on buying throughout the day, and even at the end of day also, like it opened closed at the highest point of the day. So chances are very high that market or any stock will keep on going higher, because there's a lot of demand for this stock. This is known as bullish Marubozu. Similarly, there's the opposite of that is bearish Marubozu, in which it opened at the highest point but closed at the lowest point of the day. It means that a lot of supply is there. A lot of people are ready to sell. Even from the morning till evening, they were all sellers, and the market is going down. That's why. Then it is known as hammer or paper umbrella. It depends where it is getting formed. So this means that market must have opened at this point of time. Sorry, at this, since it's green, so market must have opened at this point of time. And at the day, there was a pressure, selling pressure, but the selling pressure was overcame by the buyers, and the buyers not only closed at this point, even took it higher also. So it means that at lower level, there is some
Yeah, we can't hear you, Abhishek.
to
थोड़ा
buy
cut हो रहा है.
back, but
Your voice is breaking. Just a
okay, sir.
couple of minutes back.
Now better, sir?
Yeah, अभी ठीक है. नहीं, फिर freeze हो गया.
Okay. ठीक.
Maybe you need to switch
slightly later
networks.
on.
आपका network में थोड़ा issue है.
This is Wi-Fi, but I changed to mobile network. So can you hear me? So it's better
Yeah,
now,
we
sir.
can hear you now.
ठीक है, right.
हाँ, ठीक है.
So we'll maintain this network. So this is inverted hammer, in which what has happened, just other way around. Like what has happened in this thing is that it has opened at this point of this price, and throughout the day it went up quite a lot, but then it met with the selling pressure and then closed at this point of time. So this candle has been formed, which is known as inverted hammer. And this is a doji. It means again indecisiveness, that market participants are not very clear about it, that in which way the market is going to go. So there can be long leg doji also, or a short leg doji also, which shows the indecisiveness of the thing. Now this is again same thing which has happened in the when the candle is very strong, like open price and close price is same. So it will be this form of candle will be formed, and where the stock has gone down quite a lot and close all at exactly the same price where it started from. Similarly, other way around, where it started with this point and went up, came back and closed at the same point of time. So same point. Okay, and this is again 4-piece doji. It means all 4 things are same: open, close, high, and low price. So these things are important, and these things you will see in all kind of time frames. Let it be 5 minutes time frame, 15 minutes time frame, 60 minutes time frame. So depending on the trader's horizon, some traders are like they will choose a time frame and uske baad they will see these kind of candlestick patterns. So intraday trader will also see it if he's keeping a 5 minute chart. Even a swing trader will also study it, and even a long-term trader will also see it. But what is the right way of doing it? That first thing you should be looking at a long-term time period, and thereafter coming to a shorter time period to analyze the market. Now today what we are going to do is, now we go to the individual candlestick patterns and we'll discuss there how to trade these patterns. So first we'll cover some single candlestick patterns. Some of them I have already covered when I was teaching about the various candlesticks, and some will go in detail right now. So first and foremost is Marubozu, which I have already covered. The green Maru, there are two kind of Marubozu, green and red Marubozu. Sorry. So green is bullish and this is bearish. Now it is a very important signal. Whenever we are reading these candlestick patterns, we are supposed to see the prior trend also. What is the prior trend before this? So whether the stock has been falling from last so many days, or whether the stock has been going up for last so many days. But green Marubozu is the only, or red Marubozu is the only candle for which you don't have to see the previous pattern. You don't have to see what has happened in the past. This candle itself shows a lot or tells you a lot. So green Marubozu is like it has opened at this point of time, and throughout the day there was a buying pressure, and it has gone up and closed at the end. And bearish Marubozu is just opposite of it. So as you can see, there are many point of time the bullish Marubozu is formed, and thereafter the trend has changed or it has gone drastically up. If you see zoom the thing, then this is a bullish, almost like a bullish Marubozu, and thereafter the trend has changed. Now this is a bearish Marubozu, almost a bearish Marubozu, and thereafter it has fallen quite a lot thereafter. So these kind of patterns are visible at a lot of time. And now we come how to carry out the entry in this trade. So as I covered earlier, there is no prior trend required for this kind of Marubozu. If you are able to spot a Marubozu, suppose you see a Marubozu, so if it's a green candle, then a trader is expected to can go long, but there are two ways of going long. So one way of going long is you go long on the same day itself at the end of day. Suppose market opens at 9:15 and closes at 3:30. So at 3:20 you see, okay, a bullish Marubozu is getting formed in maybe HDFC Bank or some other stock, and a trader can take a long position on that day itself at the end of day at about 3:20 when you see bullish Marubozu getting formed. However, there are few important critical points is the length of candle should not be too small or too big. If it's too small, it means that maybe that much demand was not there. And if it's too long, suppose it is about 10% or so, then what happened, your stop loss will be very wide, because stop loss in this kind of situation will be the low of the candle. So suppose like if a bullish Marubozu is there, if it closes like this, so your stop loss will be low of this candle. So if it is a very big candle, about 10% or so, your stop loss will become very wide. It will become about 10% of stop loss, which will not be feasible. So you have to see if it's about 3 to 5% of candle or more than 2% or 2.5%, then it's ideal to go long because your stop loss will not be that wide. And aggressive trader can take this trade at the end of day, that is about 15-20. And people who are not so aggressive in nature, they can choose to trade next day when they see again there's a positive sign on the stock. And stop loss for this candle, as I covered, is the low of the candle. Similarly, for other way around, bearish Marubozu will be there, so usme stop loss will be high of the candle. Now we come to the next single candlestick, which is known as spinning top. So spinning top is almost like a doji which gets formed. So is as the name suggests, it's like there's a huge candle on the upside and huge shadow on the downside, and open close price are narrow. So it means that most of the traders are indecisive. Now, this is the pattern in which you can be cautious about that stock. Okay, this stock, there's no clear direction in the stock. If it's a previous uptrend, then maybe that uptrend is getting exhausted. If it's a downtrend, then maybe the downtrend is getting exhausted. But it doesn't give you any signal of buying or selling. It's a caution sign that it's a spring top is getting formed, and you have to be cautious about taking any decision. So in this chart also, you can see many times spinning top get formed. Sometimes it reverses also, and sometimes it's a continuation also. Like this is a kind of spinning top where doji is formed, and And at here also, there were number of spinning tops were there, but thereafter market consolidated and then broke out and went up also. So anything can happen a spinning top. A spinning top is just a sign that there's a indecisiveness in the market, and one trader has to be cautious about that stock. So there's generally a small real body, upper and shadows are longer, and as I covered, there's no trading signal. It's just a sign of caution. Then similar to spinning top are dojis. Only thing difference with doji and spinning top is that spinning top body is slightly wider and doji ka body is slightly smaller than body of a spinning top. And just like same thing as spinning top, so iska bhi implications are same. There is no decision. It's just basically it says that neither bulls nor bulls are able to influence the market. So you have to be cautious when you see this kind of sign, and it's just a no trade signal and sign of caution. So doji also, like it gets formed. This is a chart of again Nifty, and as you can see, many times doji gets formed, and it may be sign of consolidation pattern, and thereafter market may either break down or break out from the pattern. Now we come to some other more interesting patterns, which is known as paper umbrella. So paper umbrella is very important, and it depends where it is getting formed. So there are two kinds of paper umbrella. Like as I covered, iska matlab hai ki what has happened that it must have opened here, and there was a selling pressure for the day, but the selling pressure was overtaken, and thereafter market closed higher. Similarly, this is same type, but only thing is red color. So it means that market would have opened here, went down and closed, and selling pressure did not get exhausted completely, but yeah, it came out quite a lot. So it depends where it is getting formed now. So this pattern is also known as hanging man and hammer also. So suppose this pattern is getting formed at the bottom. Suppose the market has been falling from last 4 or 5 days, and thereafter this pattern gets formed, this candlestick gets formed. So this is a bullish sign, which is known as hammer. It means that chances of reversal are very high, like something like which happened on recently in Tuesday, maybe on Friday. Exactly not on Friday. Friday, what happened? There was a gap down opening and market kept on going up. But sometimes it happens that market has a flat opening, it goes down quite a lot, and thereafter comes back and closes at the same point of time. So that's known as hammer. And this is a very bullish signal, and it means your stop loss will be below the shadow of the candle to go long. But similarly, this kind of pattern can also get formed at the top also. So when it gets from the top, the same thing is known as hanging man. So pattern is same, only thing it may be getting formed at the top or maybe getting formed at the bottom. When it gets from the top, it's known as hanging man. When it's getting formed at the bottom, it's known as hammer. So previous trend is in this thing, though the candle is same, but the knowledge of prior trend is very important. You should know that what is the prior trend. If the prior trend is down and then the hammer gets formed, then it's a bullish sign. And the prior trend is like if it's a bullish trend and after 5-6 days of up days there's a hanging man, then it's not a bullish sign, it's a hanging man, it's a bearish sign. Okay? Entry will be in this case hammer, entry will be the low of the shadow will be the entry. Entry will be again either at the end of the day where the aggressive traders will take an entry at the end of day at 320, or non-aggressive traders can wait for one more day and they can take the entry on the next day. And stop loss will be low of the shadow. Similarly, for hanging man, the aggressive trader can take the entry at the end of day 320, and non-aggressive person can wait for the next day and see that some signs of weakness, and thereafter can initiate a short position with a stop loss as a high of the candle. So this was paper umbrella. So this is a chart where paper umbrella is getting formed at the top. So as you can see, this is the paper umbrella when it is getting formed at the top, and this is paper umbrella when it is getting formed at the bottom. So what has happened? The market has been falling quite a days, and then there was a doji, and then there was a paper umbrella here. So this is a sign of reversal, that chances of reversal are there, because market opened at this point, went down quite a bit, and then again closed at this point of time. So a person who is aggressive in nature, he may take a position 320 by going long in the stock, but a person who is not so aggressive in nature may take a position on the next day at the open itself when it says that okay, gap up is there and chances of strength are there. So it's a further confirmation of pattern is there. So this is paper umbrella, which is seen quite commonly, and it tries to guess the tops, or it gives you the sign of the reversal of the pattern, reversal of the trend. Then similarly, there's a known as shooting star.
Sir, one thing, if it is red or green, that doesn't matter, right?
Ma'am, doesn't make a difference, ma'am.
Okay.
But only thing, suppose like what you should understand it, that suppose there's a downward trend and then this hammer gets formed, and if it's green in color, so I will be more comfortable in taking that long trade rather than when it's red in color, because red color means that complete supply was not overcame, complete supply was not overtaken by the bulls. But if it's green in color, इसका मतलब complete supply is overtaken. Try to understand from this point of view, मैम, कि जैसे अगर उसका ग्रीन कैंडल है, मतलब everyone who has sold their stock on that day is actually feeling bad about it, that he has sold at a wrong price. But if it is red in color, so there are certain people who are still fine holding it. So that's how a green color होगा तो ज्यादा उसके implications होंगे, अगर red color होगा तो उसके implications थोड़े से weak हो जाएंगे comparatively.
Okay.
Similarly, there's a shooting star candlestick, which is just opposite of what we covered in hammer. And its maybe importance is same as what is the previous trend and way it is getting formed. So again, this kind of pattern also helps in directional trade. Knowledge of prior trend is very important, and it indicates the reversal pattern as the case of hammer. Entry is again either at 320, or aggressive traders can take at 320, and those who want to wait for another day, they can take at the opening of the next day. And stop loss is again at the higher end of the shadow or the lower end of the thing. So this is the where this hammer is getting formed, and thereafter there was a reversal. So this was like, it was some good news, and on good news it had a gap up opening, and thereafter went up also. But after that thing, it came down and closed at the same point of time. So it showed that at the higher level, reversal is there. People are not able to hold. Bulls are not able to hold it. Those who are, and they're giving up the gains. Selling pressure is increasing. So these are the some major single candlestick patterns which we have covered right now. Basically, it tells you that whether supply is more or demand is more in the commodity. So basically, it tells you supply is more or demand is more in the commodity, and you can take a decision based on that. Now we'll move to the other thing, which is multiple candlestick patterns. So single candlestick patterns are important, but they are not as reliable as multiple candlestick patterns. So the longer the more candlestick patterns are more reliable, lesser candlestick patterns are less reliable. But anyway, it teaches you, it helps you quite a lot in finding out stop losses and making a view about the market. So now we move to the multiple candlestick patterns. I hope till now everything is clear and people are with me. Fine. So we'll move to the next session, which is multiple candlestick patterns. So there are various multiple candlestick patterns, which are known as engulfing patterns, then harami, piercing patterns, dark cloud pattern, morning star, and evening star. We start with the engulfing pattern. So what happens is engulfing pattern, that the candle takes over the previous candle completely. So what happens? Let's suppose there's a downward trend and market has been falling from last few days. But what happened next day? Market has a gap down opening, means it opens below this, and thereafter the whole day market keeps on going up, and it covers the whole candle of the previous day. So it means that whoever have sold on this day, he is repenting now, because the next day market not only has opened gap down, has covered all the losses which happened on this day, and this becomes a bullish engulfing candle. So what happens in this candle pattern? Then chances of reversal are very high. The market will continue to do the uptrend, because यहाँ पे क्या है, demand has increased for the stock. So as we can see, sometimes bullish candle engulfing pattern, this is how it is formed. This is a chart of Nifty. So this is something like there was a downward trend in the market, and thereafter there was a gap down opening. Market went down for some more time, and then there was a complete reversal. And it not only covered this day, it covered even a day before that also, and closed at higher levels. So this is a bullish sign. Now some people will, again, same thing way, some aggressive traders may take a position at the end of second day, or some people can wait for the third day for a signal. The stop loss for this kind of pattern is again the low of the candle. So this low will be the stop loss, and people can trade on the long side for this kind of pattern. Helps in directional trades. Prior trend is very important, as I covered. It indicates reversal. and entry is either as at 320 or next day, and stop loss is the low of the pattern. Similarly, opposite of that is bearish engulfing pattern, where what has happened, that market is an uptrend and thereafter market is a gap up opening, but the gap up doesn't sustain. Not only doesn't sustain, it closes down and closes at the lowest point of the day and covers the whole candle of the previous day. So it means whoever has bought today, bought on this day, is actually in loss. So chances are there that the downward pressure will continue, supply will be there, and market will continue to go down. So what has happened again is same thing. Either you can take a trade at 320 or you can wait for the next day to take a trade. Stop loss will be the top end of the pattern. So this is a bearish engulfing pattern, how it is formed. So as you can see, that market had a gap up opening. It closed at this point, and thereafter not only covered previous day, it covered actually last 3-4 days. It's a breakdown completely. And next day, either a trader can take a trade on this day at the end of the 320, but he has to put a stop loss at this point of time, or he can wait for the next day opening and can take a trade on the short side, where the stop loss will be the high of the candle. So this is again a reversal pattern, where it asks you about the trend is going to change, and you can take a trade as per your view. So this I've already covered, so we'll move ahead. So similarly, in the lines of bullish engulfing and bearish engulfing, so there's a bullish piercing pattern. The only difference between bullish piercing pattern is that इसमें क्या होता है, is not covering the whole candle, but it's covering more than 50%. So इसमें भी क्या है कि it is not, I'll say it is not as strong as bullish engulfing, but it's still showing a lot of strength, which may result in a change of trend, which is opposite of bearish piercing, which is again market is an uptrend and there's a down day, which covers more than 50% of the previous candle. So that becomes a bearish piercing pattern, which indicates a reversal. So for example, this is a bullish piercing sign, where market was in a kind of consolidation or downward journey, and then this candle happened where it covered the almost about 50%, more than 50% of the previous candle, and then there was a change in trend after that. So helps in directional trade, and prior trend is important. It indicates reversal. Entry is again either at 320 or at next day, and stop loss is the again low of the pattern. So now there's a one more pattern which is known as dark cloud pattern. In this, what is happening? जैसे पिछले वाले में piercing pattern में it was more than 50%, it was just at 50%. So it's almost the same thing. Only thing, engulfing में we are covering full. Then piercing pattern में is more than 50%, and dark cloud cover में it's less than 50%. So all these things can indicate a reversal, and these are certain signs. The only thing that bullish engulfing and bearish engulfing will be a stronger pattern, and dark cloud will be the less strong pattern. So if I'm seeing two stocks and एक में मुझे लगता है bullish engulfing pattern and एक में मुझे लगता है dark cloud pattern, so I will prefer to go towards the engulfing pattern rather than choosing to a dark cloud pattern, because dark cloud pattern is not as strong as the engulfing pattern. Similarly, in the lines is Harami candlestick. Now don't go by the name. It's a buy from it's basically Japanese thing. So names are given as per the Japanese thing. So this is again a pattern which is seen quite a lot of time. And what has happened again, this pattern is again a reversal pattern. So what happened in this pattern, unlike engulfing pattern, this what happened is a long candle and then there's a short green candle. So what happens is that यहाँ पे market close हुआ था at the low point, but the next day there's a gap up opening, and thereafter market keeps on moving throughout. Though it doesn't cover the whole day, but many point of time it's marks a reversal of pattern. So again, aggressive trader may take a trade at the end of day, and non-aggressive trader may wait for one more day and can take a trade on the next day. And stop loss will be low of the pattern in this case. Similarly, other way around, bearish Harami, uptrend, and then there's a short candle. Aggressive trader can take a trade at end of day, and non-aggressive can wait for one more day. Stop loss will be high of the pattern. So this is exactly this is some sort of bullish Harami which I was able to spot in the present condition, though not exactly thing, but like it's within this thing already. But I will show you sometime else also how a bullish Harami gets formed or some live example of bullish Rami and bearish Rami pattern. So these were some examples of candles. So iska stop loss and everything I have covered in the diagram itself. Now we come to the last pattern, which is known as morning star and evening star pattern. So instead of 2-day pattern, it's generally a 3-day pattern. So what happens? Prior trend is again very important. Let's suppose the market has been falling from last so many days, and there's a red candle, and thereafter there's a gap down opening, and there's a small doji gets formed. It means it shows indecisiveness. But next day what happens? There's a gap up opening, and thereafter market keeps on rallying. So this, if it's formed at the bottom, then this is a sign of reversal pattern, and low of the pattern, this will become a stop loss for the pattern. So this is, it's something like this, like market has been falling, and then there's a doji also, which is kind of hammer, and this is a complete sign. So this complete setup becomes a morning star setup, and a trader can go long either at the end of this day, or it can wait for the next day to entry, depending on whether he's aggressive trader or a non-aggressive trader. And stop loss will be low of the candle. This is morning star, and opposite of that is evening star. That there's an uptrend, and then there's a gap up opening, and a small doji gets formed, and next day there's a gap down opening, and the whole gains are reversed. So aggressive trader can take a short position here, and with a stop loss above the evening star, and can carry a downward trade. Something like this. This pattern itself becomes a evening star pattern where there's an uptrend. So there's a evening star gets formed, and this candle is there. So this is the whole 3-day pattern. And thereafter a trader can take either trade here or next day itself with a stop loss at the top of the shadow. So these are total about, we have covered about total 16 candlestick patterns, which are some single candlestick patterns and some multiple candlestick patterns. Now there are many more candlestick patterns which you can go through, but we are restricting to about the 16 candlestick patterns because these are more prominent, and generally you will see these working out more than other patterns. The idea is to understand that basic assumption that as a technical trader, you are buying strength and selling weakness. So that is very important, that you have to understand that you will always buy a stock which is going up, and you will sell a stock which is going down. So इस वाले केस में we are trying to find out reversal patterns, and we are trying to find out कि जब a stock is falling, when इसका supply is getting over and demand is emerging at some point of time. And one thing which I have not covered till now, and no one has asked me also, I have given you entry setup. I have given you entry setup. Okay, this is the stop loss, this is the entry, but we have not covered about the target. So how to find out target, we will cover in the next session, that how to find out target for these kind of patterns. Today we have just covered the how to find out the entry in these setups. And this is not all. This is, I will say, this is just a part of technical analysis in which you are finding some strength and some weakness in a commodity. But just based on this, we will not take a entry. How to take an entry will depend on a lot of other things, which we'll cover in the sessions to come. That why other things important, and based on those things, then we'll decide whether to take an entry or not to take an entry, depending on risk and reward ratio and other things. But this is the basic of technical analysis, where we are trying to understand how to read a chart and how to find out whether the strength is there or weakness is there in a stock, and based on that, how to take a decision, how to put a stop loss, and what kind of patterns we are likely to see in the chart patterns. So till now we have covered these 16 chart patterns. Now I'll go to some other thing which is about trend, not exactly with technical analysis, but again, understanding trends help us a lot in taking our decisions. So basically we'll say we are covering Dow theory, in which says that market always moves in trends, and these trends are primary trend, secondary trend, and then the minor trend. So there's a primary trend, which is the most important trend which is happening right now. Let's suppose the primary trend is what determines the long-term trend of the market. So long-term trend is like, as we know that all the markets are generally in an uptrend, whether it's Dow Jones or Indian market. So we can say primary trend is up right now, and within the primary trend there will be secondary trends also, which is known as corrections. So, and these corrections will be there like this, in which it will give up substantial gain, and thereafter will resume the primary trend. So there are three kind of market: bull market, bear market, and consolidation market. So let's suppose this is bull market, and what happens in a bull market? Market will move in a primary trend in which it always makes a higher high and higher bottom. So This is the bull market. It makes a higher high, higher bottom, and thereafter it continues, and thereafter again goes for consolidation correction, but makes a bottom which is much higher than the previous bottom or previous high, and thereafter continues up. So this is a typical bull market in which you'll always see higher highs and higher bottoms. So in this, what is happening? The primary trend is up. So mostly what happens since primary trend is up, so up move will be larger than the correction move. Correction move will always be smaller than the up move. For example, suppose Nifty has gone from 10,000 to 12,500. Let's suppose 2,500 points. So correction will be close to about 833 points. It will be even lesser than this 2,500 points, close to about 1/3 or so. So this will become a secondary. However, in bear market, opposite will happen. When there's a bear market, the main trend of the market becomes down. So what will happen? All the tops will be lesser at lesser height than the previous tops, and all the bottoms will be lower than the previous bottom. So this will become a bearish phase of the market. So there are two phases, bull phase and bear phase. How to identify a trend is when you see higher top getting formed, a higher bottom getting formed, it's a bull market. And when the lower bottom and lower tops are getting formed, it's a bear market. And in somewhere in between, there's a minor trend or secondary. Basically, minor trend is again a part of secondary trend. So what happens in minor trend is, like suppose this is an uptrend and इसमें downtrend है, तो इस downtrend में भी there will be minor uptrend, और इस uptrend में भी there will be a minor downtrend. So this is known as minor trend. So but broadly, if you are able to identify the trend, what is the trend, it will help you in taking decision that okay, what kind of decisions I am taking and what will be my time duration. So now all these things, as I covered, it always moves in phases. It doesn't go in one way. So there's an accumulation phase. So this is the first stage of a bull market, which is known as accumulation phase, and it's a start of an uptrend. So what has happened? Let's suppose what happened in 2008, something like that. That market has fallen quite a lot, and then no one is interested in the market. And at that point of time, smart investors, they start accumulating the stocks, and because of it, certain patterns get formed. And thereafter, at this point of time, only smart and those who are like long-term investors, they start and they enter the market. Then comes the public participation phase. So in this phase, what happens? That market has already gone up quite a lot, and thereafter, public is able to realize it. Okay, the market has gone up, and there's an opportunity to make money, and a lot of public start coming into these stocks, and they start participating in this public participation phase. So generally, this phase is the longest phase in the market, where maximum I'll say up move happen in this phase only. And then there's the excess phase. So in this, what happens? Excess phase, that there's a euphoria sort of thing in the market, that because there are a lot of people who feel that they know a lot about market, a lot of retailers come into phase, and because of that, a lot of demand is there for stocks, and sometimes the demand is not matched by the fundamentals, and but people are still into buying, so there's a euphoria, and market makes a very large gain sometime in this point of phase, which is known as euphoria phase. And thereafter, top gets formed. And once the top gets formed, then reverse process started. Again, there's a distribution phase in which what happens? That markets start, people, the smart investors, and they see there's no value in the market. So they start selling the overbought stocks at some point of time. And then the market goes on a decline. So once the market goes in a decline, there's a public participation in this phase where all people realize, okay, people are selling now and the market is not a right place to be. And they start exiting the market. And this is followed by capitulation phase, in which what happens? Panic phase is there when everyone wants to sell whatever they have, and a panic gets formed, and there's a large fall in very small point of time. And that's how capitulation phase happens. And this capitulation phase again results into a accumulation phase where the smart investors starts buying. So this is a typical Doe theory, in which you are able to find out what are the various phases in the market and what are the various, how to identify these phases. So for example, like this is a Nifty, if you see Nifty ka chart, this is a long-term chart. So I will say like this is 2004 ka market, and at this point, this is the accumulation phase when market corrected about 30% or so. And yahan se accumulation phase started, and thereafter market took the previous high, and thereafter it kept on going with some minor corrections about 10 to 20%. And this is the public participation phase, whole phase, jahan pe whole public is investing and all the dips are being bought into. Sometimes corrections were smaller, sometimes correction was bigger, but this phase was quite a big phase from 2005 to 2008 or so, and market has moved quite significantly at this point of time. It has almost tripled in about 3-4 years. And this is the phase where euphoria is setting in. Now you see the how the when the euphoria sets in, there's a vertical rise in the market, and everyone wants to be part of the market. So all the dips are being bought into, and it goes into a exuberance and irrational pricing. So I remember at this point of time, I was actively trading in the market, and I have seen like stocks like Unitech, which has a very low fundamental value, JP Associate, even DLF at that point of time. They used to be the market darlings at that point of time, and they were trading at exuberance valuation. Like Unitech was trading at about 300 rupees, and it was at a very high PE of about 200 or so. Similarly for DLF also. So this is how the exuberance phase is there, and thereafter the distribution phase started, which is very volatile, and market has a very choppy movement in this distribution phase, and thereafter the sell-off starts. So once the sell-off starts, after some time market corrects quite a lot, and thereafter there's a public participation phase where gradually people start selling because now they are not able to hold that hold till now, but they are used to see that people are getting rewarded of buying. But now for the first time, the people or public, they start feeling the pinch when they see over many years whatever returns they have made, they have not worked out well, and they start disowning equities. And thereafter, at the point where everyone gets tired, is the capitulation phase, where the market corrects subsequently in a very short point of time. Now this is capitulation phase again, जहाँ पे sudden fall comes and the market falls quite a lot. And this is the point again जहाँ पे जो smart investors होते हैं, they see the fundamental value in the stocks and they start accumulating. So यहाँ पे एक head and shoulder type pattern got formed, which is a bottom out formation, and thereafter again the cycle starts जहाँ पे accumulation phase के बाद से फिर से market goes up, the again public participation phase starts, and again it may lead into euphoria. So generally what happens, the market always repeats these cycles, whatever because we believe in technical, so we also believe that all these phases will be repeated again. So in the present case also, so we may be either into public participation phase or maybe in the euphoria stage. I personally feel we are in the public participation phase and not in the euphoria stage as of now also, because we have not seen large rises till now. So what happens is exuberance is we will see very huge rises. So at this point of time, I remember Nifty used to go up close to about 500 points each day. So this is when market was at 5,000. And at 5,500 points means close to about 10% or close to about 5%, somewhere close to that only. So I've seen that kind of moves. जहाँ पे Nifty used to move about close to 4% a day, and it doesn't happen stop. It kept on moving many days like that, and it went from like close to 4,500 to about 6,000 in a very short point of time, which is close to about 30% rally. So this is how euphoria phase is being. So आज के time पे if you see the market at about 20,000, so close to about, if you see 5%, मतलब close to about 1,000 point. So once you see the market moving 1,000 points a day, and that's the time that we may be entering into euphoria phase of the market. And when the subsequent falls comes, it almost as double the pain of euphoria. So suppose market has been going up, यहाँ पे it was going up 500 points a day. When it started falling, it fell close to about 1,000 points per day. So that's what happens. So same thing will happen in our market also. Okay, if it's going by 1,000 points, so this time when the fall happens, Nifty may fall by 2,000 points a day, which is about close to about so not 2,000, yeah, something like that, 1,500 to 2,000 points a day. So that kind of things will happen in the market. So you have to be prepared for that. So this is
Abhishek,
all what I have to.
one,
Sir.
one doubt here,
Sir.
rather not just doubt it. See, here in this, when you were showing these patterns,
Sir.
while this could be attributed to euphoria, but this also, as you will agree, that it happened because of the financial crisis, which resulted
Sir,
in this kind of a downfall of the market.
Sir.
And also, if we look at the bottom of 2009, from there
Sir.
again, there was we didn't have this kind of a fall till COVID.
Sir.
So we had minor corrections, I'm sure,
Sir.
where the market was correcting regularly, which always happens. But the trend was primarily up, and eventually we again saw this kind of a correction because of COVID.
Sir.
Now, both COVID as well as the world financial crisis were because of certain events.
Sir.
and may not actually be attributed only to euphoria of public participation, as you said. So
Sir.
my doubt is that this is it that the technical itself are the reason. For example, if let's say in 2008 when the market started falling, uh, when the Lehman Brothers crisis happened, should people have waited for the technicals to set in, or they should have understood that the macros have as it is given a signal to exit? So how do you now kind of relate this? I know it's a little complicated question I'm asking, but
No, sir. So I'll come to your point, sir. So see, what you are asking is that this phenomena happen, and can we find out from technical analysis exactly that this may happen and how to take advantage of that? So technical analysis is the short term, can give you some short term things, and not necessarily give you everything. But if you know about technical analysis, so what will happen once these things set in? So you will be able to find out what kind of trades you can take to be profitable in the market. Not necessarily it will be able to find out that when is that big correction of 50% is going to take place. So generally what happens, 50% correction take place once in 10 years. So it may be very different reasons, but generally it takes about 10 years to have these patterns. And within these 10 years, every 2-3 years, you will have a correction of 20% to 30%, which is again part of the normal market. But what technical analysis will help you do it, when these corrections come of 20 to 30%, how to take a trade and how to be consistent and profitable in those kind of situations. And when the reversal also happens, it will help you in identifying those reversals so that you can take trade in the direction which you're supposed to take a trade. And it will make you mentally prepared that these kind of things happen, and you can really expect them and how to take advantage of that. So I will say technical analysis cannot predict what is going to happen exactly, but because of chart patterns and all, it will give you some guidance that how you can take a trade, where you can put a stop loss, what can be target for these kind of patterns, and how you can take these kind of trades. For long term, sir, I will say there's a saying that more money has been lost in waiting for corrections rather than actual corrections. So if you keep on waiting for corrections, I'll only invest in corrections. So generally, these kind of people never invest in the market because they always keep on waiting for the corrections, and market can always fall more. So you cannot think that मैं correction में wait करूँ, correction जब होगा 50% का मैं तभी invest करूँगा, या जब 30% correction आएगा मैं तभी invest करूँगा, because after a fall of 30% correction, market can again fall for another 10%. If you are fearful at top, you will be fearful at bottom also. So exactly technical analysis is not able to tell you कि this correction is going to be 50% or this correction is going to be 10% or so, but it will give you some signals, okay, that market may be bottoming out in a short term or maybe topping out in a short term, and you can take a trade based on that view. If it's basically, it gives you a good entry point and good target point so that you can execute a trade. But it will not be able to tell you exactly that 50% going correction is going to come or is not going to come, sir.
probably I could not phrase my question correct. Let's say this, we say from 2003, let's say till 2009, this was a bull market. 2008, before the correction started. From 2003 to 2008, it was a bull market with, of course,
Yes,
minor corrections which has happened in 2004 and again 2006. But overall, the trend was uptrend like we are witnessing right now.
Yes, sir.
And then there was this major fall because of the Lehman Brothers crisis.
Sir.
Again, we post that we had a bull market, and maybe we also for some years we had probably a sideward trending market where the market kept moving between which a range bound.
Sure.
So can we do long-term research come to some kind of a figure that if a market has corrected more than this percent, maybe we are now seeing a bigger trend change, and this is not a minor correction. And
Sure.
if it is correcting beyond, so can we attribute that to some historical data, or like you can say we may not probably be very accurate if we go by the past and then attribute some percentages to see when is the market finally changing from a bull market to a bear market?
Okay, sir. So exactly, maybe I'm not able to answer the question right now properly, but sir, you cannot find exactly when the top is getting formed, and neither is the bottom. You cannot find out exactly when the bottom is getting formed, sir. But certain signals will be there which will show you, okay, maybe the top is getting formed or maybe the bottom is getting formed. But if you're like long term, you'll be always bull market. Whenever the correction comes, sir, a fundamental person, if it's sitting with cash, he will deploy more cash. But in my experience, no one can time it, sir. No one can exactly time it when is the bottom going to get formed and when is the top is going to get formed. Through the help of technical analysis, you can help out short-term trends. Okay, this correction is there, and let's suppose if this example is there. Now, when we say present market condition, so now we say present market condition, the market has broken down 20,500 ka level and is closer to support level at 22,000, 21,800 से लेके 22,000.
800, yeah.
Yes, sir. So you can now, depending on the pattern, suppose some pattern gets formed and you get a sign of a bullish sign, then you will take a trade on the long side. If the pattern gets, suppose market starts breaking down 21,800, so you will take a trade on the short side. But at 21,800, if suppose it breaks down, no one knows whether this correction is going to be 30%, 40%, 50%, or it will reverse from some point of time. So that you cannot answer, but a short-term trades can be taken depending on technical analysis, sir. Long term, sir, you cannot say that market will stop. Like there's no sign. Generally, what has happened that in a 10-year time period, there's a 50% correction, and it happens because of any reason. Like before 2008, also there was a 2000 crash when the IT bubble was there, and IT
Yeah,
bubble got corrected.
.com bubble, yeah.
.com bubble. So every 10 years, there's a generally a 50% correction because उससे पहले exuberance भी होती है, and all these favorite stocks get corrected at that point of time. And this 20%, 30% correction, like they happen quite normally. 10% correction happens every year almost, sir. Somehow it has not happened in past 2-3 years, but उससे पहले मैंने देखा था 10% correction was very normal part of the thing. So 20% correction used to be something like once in 2 years or 3 years kind of thing, and 50% correction used to happen every 10 years. So these are the normal cycles which happen, but you cannot predict that this correction is going to be 20%, this correction is going to be 10%. That is very difficult to find out, sir. You can get some patterns, and based on those patterns, you can carry out trades, sir. And these patterns I'll cover, sir, subsequently. Our next class will be about chart patterns and all, where we will cover chart patterns and how to trade those patterns and take advantage of these signals, sir.
Okay, thank you.
Sir, Ravinder, sir, any questions, sir?
Yes, I just wanted to know if I'm a long-term investor,
Sir.
how this analysis is going to help me in any way.
So
Let's
this,
say I spend the money for 4-5 years and I forget about it. What I'll do with these charts?
okay, sir. So for if you're a very long-term investor, how do you invest? At mutual funds or stocks, sir?
Let's say I buy today and forget for next 5 years. I'm
No,
just thinking about that.
but
Does it in any way help me?
So you choose stocks or you choose mutual funds?
Anyway, let's say for anything, somebody gave me a tip, or I feel this stock is okay, I buy it for any reason.
So for if you
I just want to know.
so it will help you quite a lot in choosing. In suppose someone gives you tips, sir, that buy this stock because of this reason, sir. But if you know about fundamentals and technicals of that stock, it will help you find out whether to buy that stock or not, sir, based on patterns and all, sir. Because sir, if you find that okay, technically it's already overbought, then you may think of not buying it. But if you find some patterns in the stock which are technically like giving you view okay, fundamentally also the strongest stock, plus technically also is showing some pattern, then you may be more inclined to buy that stock, sir. And if you are into tips and also, so then of course there's no
I'm
point,
just
sir.
saying, you feel this is different stock will rise up, so buy the stock. So like that.
Sir,
So
but
I feel,
just
will it
just
help me anyway? I just wanted to know.
so जैसे suppose sir जैसे HAL है या BEL है, so what will happen is that you will be able to spot the patterns. That suppose HAL is going up, sir. So these, I will say these are part of a bull market. So जहाँ पे ना some stocks become favorites. Like in 2008 also, there some stock became favorite and they win multiple time up, sir. And but if you have understanding of markets, sir, you will be able to understand whenever suppose you see a top formation getting happened, so you'll be cautious. Okay, now maybe this top is getting formed, so I should exit maybe or shall lighter my position, even if you're a long-term player also. Or suppose, sir, if you see a stock which is already overbought and you don't see any pattern, so you will not be, you will not try to invest in that stock. You will wait for some correction, you will wait for some patterns, and that will give you better entry maybe, sir. But if you just want to go on that thing that okay, HL is a long term, I'm going for 5 years, तो उसका कोई आंसर नहीं है, sir. If you are convinced about it and you are believing fundamentals, so you can go for it, sir, and it can become a multiple gainer from here also. But it may reverse also. No one knows the answer, sir. Ki HL, what will happen in HL, sir, or any other defense stock. Let's suppose, sir, tomorrow anything happens. Let's suppose BJP doesn't perform so well in elections. Suddenly the story will turn around, sir, and everyone will try to exit these kind of stocks. So the whole cycle will change, sir. So it all depends on a lot of other things, sir. But you cannot have one right answer for anything. But only thing that happens is when you have technical analysis advantage, sir, analysis, sir, you're able to analyze some patterns, sir, which will able to give you some advantage in short term and even some 3 to 6 months horizon also, sir.
Let us say that as everybody is saying that maybe in a matter of 3, 4, 6 months, that the market is going to go down by 20%. Can we
Yeah.
predict from these charts if it's likely to go, when it's likely to go?
So you cannot exactly predict it that when is likely to happen and what is likely to happen, but it will give you enough signals, sir. Like I'll just show you, sir. It will tell you what to do and it will just guide you so quite a lot, sir. Just for example, sir, let's say this is. I'll just open the Nifty chart, sir. I think you're not able to see my screen. So like sir, this is Nifty ka chart, sir. Now I'll just give you some examples. So technically, what happened at 22,500, it was a very bullish sign that 22,500 will be broken out and it will go up to 22,700 and 800. And I covered in my YouTube channel also. So just because it was given technically sign, so it went up and uske baad is broke down 22,500. So person who knows technicals, he will know that 22,500 was a support and has broken down. He will not try to buy it here. He will wait for certain patterns to emerge to initiate a fresh buy. But a person who doesn't know about technicals, he may keep on buying on all the dips. But a person who knows about the technicals, he will wait for some certain patterns to emerge and will take a more informed decision rather than just keep on thinking that I'll keep on buying on dips. And a person who doesn't have knowledge about technicals and derivatives, I will say, sir, will likely to underperform quite a lot, sir, in present scenario, sir. A person who has knowledge of fundamentals and technicals is likely to perform much better than person who doesn't have knowledge of fundamental technicals and derivative. The answer is not one. Like I will not say fundamental is the right thing or technical is the right thing or derivative is the right thing. I think a trader or investor should know everything. If you are in this game, sir, only then you can take all the advantages. If you restrict, I will believe only in fundamentals. So what happens, sir? Fundamentally, like right now you have bought HAL, but many years back you would have bought ITC, and you could have waited for many years. Okay, or fundamentally, so HDFC Bank is also quite good, sir, but it's not going up. Though is fundamentally is quite okay at these valuations, but it's still in the range from last so many years. So fundamentally, sometimes you may get stuck for a lot of reasons. And even if you have horizon of 5 years, 6 years, if you don't understand technicals very well, sometimes you will not even know we should exit this stock or should not exit. But if you are a technical person, you will be able to understand, okay, maybe everything is getting already priced in and technicals are indicating you, okay, maybe everything is getting priced in and you can exit. Like I'll give you an example of a ITC stock just for learning purpose. So this is when Corona happened, sir, at this point of time. And usse pehle this thing was in long range, kind of a very, very long range. And this was the time when ITC broke out 320 ka level at some point of time. So a person who is following technicals, he would have bought at this point of time. He would have not bought at this point of time, maybe not at this point of time, but then he would have bought at this point of time and would have reaped the benefits when it went all the way to 500 because the target was close to 500. And he would have not been stuck in the stock for such a long time. He would have waited for the breakout to happen and then would have bought it. So these, even if you're completely fundamental investor also, technical helps you a lot in identify those stocks. Similarly with the SBI case, sir, SBI was in a range for last so many years. From, if you see, from 2011 to 2020 tak, it was a range of 360 se leke 120. But a person who is following technicals, he would have bought it once the breakout would have happened, because you buy strength and sell weakness. So once he would have seen a breakout, only then he would have bought it, and he would have taken the advantage from these 360 levels to 750 levels. So that's the difference. As in the fundamentally, SBI was very weak at this point of time or very strong at this point of time. Technicals help in identifying these patterns, sir. And as you'll understand, as you'll go through the course, you will realize that these, you will yourself, I'll ask you to find out yourself itself which stocks you should hold and which stock you should not hold. kind of.
Okay. Okay. Thank you.
Right, sir. Anything else anyone wants to ask? Namrata ma'am, have you understood anything, ma'am? All things fine, ma'am?
Yes, sir.
Okay, ma'am. Please
It just
feel free to
going
ask.
so it's everything is going so fast. I think I have to rewatch your video again.
Okay,
If
I
I
think
want,
this is my problem. I speak very fast, but I'll try to slow down in the next video. Sir, yes, sir.
if I want to see the video again, how can I see it?
So what I'll do, sir, I have recorded these videos. I will put it in the WhatsApp group, sir. Same WhatsApp group. There's a YouTube channel. I'll upload it there, maybe tomorrow or so, and then you can see it, sir.
Okay.
Right. Right. Anyone else? Any question? Anything which is not understood? Any point for suggestion? Any suggestion you want to make for the next session? Okay. So one thing is, Namrata ma'am, I'll go slow in the next session. So this is like my problem. I generally tend to be faster. So I'll try to be slow in the next session. And next session we'll cover chart patterns, in which we'll find out what are the continuation pattern, what are the reversal pattern. And if you personally ask me, I generally trade with chart patterns. So these candlestick patterns which I've covered, these are single candlestick and multiple candlestick patterns. So this will give you just an indication. Okay, buying may emerge or selling may emerge, but this is not a complete buy or sell signal. We do a confluence of things. Confluence means we mix up, we see a lot of things together, like support and resistance, volumes, and other moving averages, which I'll cover in subsequent session, and which will help us in finding out more meaningful entries and more meaningful targets. So this is just an introductory section where we are trying to find out what is candlestick help us in telling us about. So that's all for today's session. And now we'll have a next session on next week. Just I want to know, I'll put in the group whether you want it on Saturday or Sunday, and what time is more comfortable, morning or evening. We'll put as per the comfort of the participants, in which most of the participants are comfortable. So thank you so much, and I'm calling on the video now.
Thank you, Abhishek.
Thank you.
Thank you.
Thank you so much.
Thank you, ma'am.
Bye bye.
Bye, ma'am. Bye.